Welcome to Accounting Year YouTube channel.
Right, so I'm recording, I'm sharing my screen now. Yeah, so if you have any specific questions, you can ask. So I'm listening to everybody just to hear if anybody has any specific question. So this, once again, is a YouTube channel. Just to make you aware, this was the last class. I'm going to copy the link and drop it in the chat. I was on mute. Hello, everyone. Sorry, I have been talking for a while. I didn't know I was on mute. Thanks for joining. I said we should try and hold on to other people to join. Hopefully, if we attain 20 before 2:15, we commence. But if we get to 2:15 and we not attain 20, we commence. So those are the two options. Now, the second part is, I mentioned that this class, based on the feedback we get from this class, will most likely be holding similar sessions, and it may not be often, maybe once in a month, and we're going to tackle practical accounting related problems, right, that we would share knowledge on. Right, off my head, what I'm thinking of we should do is a typical loan schedule, right? Meaning that we work around creating a loan schedule. If you have any other thing that you think we should walk through and create a content on that people could learn. So we're not just looking at one person's need, we're trying to look at something that is pervasive. That means a lot of people are actually interested in it, right? So you could suggest, and we'll consider that and can plan for a short class around that, right? That's that one. Then the other option I also mentioned was that for those who were not available in the last class, we will not be repeating it, but we just breeze through it. However, the link shared in the chat room is a link to what was covered, the recording on the last class. So you could go to the YouTube channel to watch through the whole session. And the last class covered the preparation of the finalization of the mapping of the trial balance, the preparation of income statements, and the preparation of statement of financial position, and the notes to the account. So those are the parts we focused on, right? So now this class is leveraging on what was taught in that class. So as a result, we will not be walking through those basics anymore. We'll just be linking and determining our cash flow, and we'll be done with that bit. So for the sake of this class, I was asking if anybody has any question based on the last class or any of the other classes we've heard so far, you can ask, or anything that comes to mind that you want to ask based on. So the floor is open for any other contribution.
Hello, good afternoon.
Yeah, good afternoon.
My name is Hilary. I really enjoyed the class and I want to really appreciate you for what you've done. From what we did yesterday, the trial balance mapping, I discovered that you already gave us a trial balance. And I saw that that is where the major work is.
Yes.
You know, trying to make sure that you classify the items accordingly. So I do not know if all of us have that knowledge, because that trial balance was well classified. So I do not know if that's something you can give us as a guide. I know that it is industry specific.
Okay.
I know that you work on the company and the service or activity that they render. So I don't know if you have any form of guide that one can use to really work on trial balance.
Okay. If I want to answer your question, so this is what I said in class 1, section 1. So if you watch the YouTube channel or section 1, you will see some insights which I provided as regards how you could manage that. So first, right? So, but however, I would explain what we considered. Now, typically, a business that is properly structured, right? At the point when the chart of account is being created, what happens is that because you understand the business, you would structure your chart of account so that it follows the order in which the business has transactions or classes that fall within that range. So for example, what do I mean? Now, if you look at this trial balance, for example, if you look carefully, the first three digits here, 100, which is 100, you'll notice that everything related to PPE all starts with 100, right? Software is 101, right? Inventory is 200. Trade and other receivable is 201, right? 201, so trade receivable is 201, trade and other receivable is 202, right? Cash and bank is 203, trade payable is 300, accrual and other payable is 302, tax is 303, statutory payable is 304. So what am I saying in the next sense? From the very beginning, right, a typical account, at the point when the chart of account is being created, someone would have taken his time to look at the business and see what are those things that are peculiar to the business that you should have. And also, spaces will be left such that when you want to create new sections, right, that relate to that business, you can create new sections in a chart of accounts for something. So you don't just make everything tight so that you don't create space for possible creation of other sections within the chart of accounts. That is one. If you are new to that particular business, there's a high probability that if you meet someone that's quite knowledgeable about the general ledger, even when the chart of account is not properly structured, they can understand what transaction flows into each GL, right? So if you discuss with someone that's quite knowledgeable about transactions being posted into the GL, you can discuss and identify what each GL represents and what kind of transaction flow into those GLs. Then you can classify the trial balance. The third option is that if there's an existing management account, based on the management account, the chart of the mapping of that management account, you can identify each classification where it should fall to, right? So those are the three options I made mention of in the first class. One, the chart of accounts would have been structured in such a way that it makes mapping of the trial balance easy. Two, you approach someone who is knowledgeable about posting into the general ledger and identify the classifications of all transactions. So because of you understand how a financial statement is structured, right? You know what should flow into the primary statement, that's your income statement and your balance sheet or your statement of financial position. You know what should form the notes. Now, the notes is a combination of one, your understanding of what the financial statement should contain. Two, what are those things that management is interested in knowing about what the value should be, right? It's also critical. When you answer those questions, right, sincerely, and the third one is that you can actually use an existing management account. Don't forget that there's possibility that someone would have made a mistake in a previous management account. So an easier approach is that you can easily still go to the GL itself and actually look at what are the transactions that are being posted into this GL. If there's no error in posting, right, and what is meant to be posted into a particular GL is consistent, then you may not have a problem. Do you get? I don't know if that answers your question.
Yes, you did. Thank you very much.
Okay. Very much. You're welcome. Okay. Any other question, please? Okay. So we're just about 3 minutes to 2:15. We're exactly 11 people right now in the class. As much as possible, we don't want to avoid going back because when we start, we started and we just kick on, right? And we may not go back, right? What will happen is whoever misses that section will most likely has to go back to the YouTube channel to watch what from the beginning of the class to the end, right? So quickly, just go through what we've done so far. Day one, what we tried to do was try to explain Excel, the role of Excel in preparing the management account. So what we did was that we walked through typical Excel function, right? We walked through typical Excel function, and we walked through absolute, relative, and mixed referencing. We walked through date functions, right? We walked through data validation in Excel. we worked through text function, we did VLOOKUP, and when VLOOKUP true, and we also did SUMIF, right? Based on that knowledge, we now applied that into the preparation of manual account. First, we started with creating the cover page, which summarizes the entire manual account. We use the date function to create this so that we can link the title to the date, so that if someone comes here and changes the date, right, automatically you will see that the heading changes. And if you go to any sheet, it changes all the way like that. Income statement, all the way. Statement of financial position, all the way, right? And that makes our account quite well structured, right? And that's what we did then. Now, after we had done that, we created what we call the table of content. The table of content are all the components on the financial statement we're interested in. So that means I can easily click on this link and I can get to each of the sections I'm interested in. So I click on cash flow, it comes here, right? And that's what we did there. And we made use of what we call Control K. When we are done with that, the next thing was the trial balance. We mapped the trial balance, right? And we mapped the trial balance based on all the components of what we want to see on the face of the financial statement and what we want to see on the note level. And that's what we used. Now, one thing I need to bring your attention is that most times, what will happen is that what we call TB will actually be what we call FS mapping, right? We will now most likely have TB in a separate sheet, right? What will now happen is that the moment you export your trial balance from your software, you can easily dump it here, right? And you can use like a function like VLOOKUP to now bring in the value based on the GL code to bring in the value here. That way, it's only when the only time you alter this mapping is when there's a new GL. So when there's a new GL, you just add the GL in the right category and put in the value, right? Another thing I didn't mention also is the fact that if you don't want to struggle with SUMIF, you can actually just create subsections like this, create subsections, and you can find totals, right? You can find totals like this. Just do total, right? Come here, also total, and do a total here, right? Inventory, we just create a cell here, and we draw a total, right? Draw a total. Now, in trade and other receivable, you notice that we have almost like 3 sections. So we can break it down like this. Trade receivable is one section. We find our total here. Total. Prepayment is one section. So at times you may have multiple GLs. You find our total here and our total here, right? Other receivables in that section, we have our total here and we have our total here, right? So instead of doing my SUMIF, I can easily now, based on this, I can easily come to my notes, right? And pick this line, just put equal to, for the sake of example in this class. Let me go to where we had the inventory. Yeah, I can easily just come here, put my equal to, and go to my FS mapping, and choose the line for inventory, and I'll select it. Similar, I can also do for trade and receivable. Put my equal to, go to my FS mapping, and select trade and receivable, which is trade receivable here, right? Equal to, go to my FS mapping. I can choose my prepayment, enter. Then the last one is other receivable. Put my equal to, go to the FS mapping, and I put my total here. Now, this is a simple approach, right? If you don't want to bother yourself with SUMIF, you can easily do this. And trust me, this works fine. It will do exactly what you're doing with SUMIF. The only difference now is that the good thing about SUMIF now is that if you want to change the mapping, right, whereby this other approach, if there's a mapping, you need to practically copy the line and move it to the category it falls in. But for the purpose of SUMIF, you can easily just copy this and paste here, right? Now, what you notice automatically now, if I go to my notes, is that if you notice, prepayment has what? Increased to 15.3, right? 15.3. Right? It has considered it. But if you look at my other receivable, that has not changed. That is the advantage that, that's the advantage that SUMIF will bring to you. You can easily just change the mapping and the effect automatically updates properly at the note level or wherever at the financial statement level. But at this other level, if you follow the approach of creating subcategories, you would need to now move a line, for example, copy this and move it to the line where you have prepayment and do a total there. Yeah, this way, if you go to the note level, you will see that you don't have any difference anymore, right? So that is a scenario around how you could possibly use that other approach in the mapping to your note level. I hope that makes sense. You can try that on your own and prepare the entire thing based on that concept, which I've just explained now, right? And that would work. And at that level, you can now also, what you can do again is that you can create totals for your current asset, total for your non-current asset and all. And that will help you do a check in terms of the net assets and all. So that's what I'm going to say about that, right? So now let's move into the section of today. Now, our purpose of the class now is to take cash flow. Now, cash flow is usually a major problem for most accountants, right? But I can tell you that cash flow is still dependent on debit and credit, right? But you would not see it. But if you understand how it works, you realize everything is just simply debit and credit. Now, what I usually tell people is that if you want to understand it, first let's go to the financial statements, right? Now, typically, there's a movement between this figure, your assets, all the lines here, right? Basically, what you are doing now is copy the lines here, copy the line here. Yeah. So basically, in cash flow, what you're basically doing now is that if you notice, if I do this, minus this, I get the figure here. Let me sum all the movements in assets. Sum everything here. I have 1.19. Let me sum everything in my payables. Yeah, I have this. So my payables less my assets. Hold on, let me check. Let me see what I do wrong. Trying to identify if there's any line we missed out. Okay, anyways, let me just do it this way. Let me see, because normally what should happen is that after everything I've done here, if I sum everything along this line, it should be equal to 0. Yeah, it should be equal to 0. So I'm surprised why this didn't work. Yeah. Okay. Okay, yeah, exactly. So this plus this is equal to 0. Now, what I've basically done is that I've done the movement in my payables and movement in my receivable. So then what we're trying to do in cash flow basically is explain this 6.65 million. We're trying to explain what has happened in cash, right? In the period. We're trying to explain it. And that movement, we're trying to explain that movement in terms of what has happened in each line. That's basically what we're doing in cash flow. Explaining what has happened in each line, but we now need to identify. Now, for our cash flow from our typical accounting classes, we know that our cash flow has 3 components. You have your operating activities, you have your financing activity, and you have your investing activity. Operating activity is the core operation of the business. What does the business do to generate cash, right? And it's critical to any business. Your operating activity is the reason why you're in business, right? Which we need to understand that part. Now, your financing activity and your investing activities are the things you need, how you've raised funds or how you've utilized funds in supporting your operations. So, for example, your investing activity has to do with how you've now acquired assets or how you put idle funds in investments so that you can gain return, right? That's your investing activity. Your financing activity is looking at, oh, I can raise funds. I can raise funds through equity or through debt. So how have I raised funds using that approach? And how have I settled those debts that I've raised, right? So for example, I'm going to settle debts, either I'm paying principal repayment or I'm paying interest repayment. From an equity point of view, how am I paying dividend, right, to my shareholders? Or basically that's the idea. Or have I issued shares to new shareholders or to existing shareholders? That's the idea behind it. So basically, in cash flow, that is what we want to do, right? I'm going to now break it down into those three components. So like we did in last class, the first component we first do is basically just take this and go to our cash flow and paste it here, right? For the sake of example, what we'll change this one to statement of cash flow, right? And we achieve that. The next one now is identify the components: operating activity, right? Investing activity, and financing activity. Okay, sorry, just give me 2 minutes. I'm about changing my source of power. No, no. Okay, so continuing from where we stopped, we've broken down the components. Now, the next thing we ask ourselves is that within operating activity, what are the components that would help us within our operating activity, right? Now, the first step within operating activity for a typical cash flow is that we would have to choose where we're starting from. Now, typically for most accountants, some will start from profit for the year, some start from PBT, some start from EBITDA. Where you start from doesn't really matter, right? The only impact is that wherever you start from will have an implication on what you need to adjust. Don't forget that your cash flow is the only statement in your primary three statements that is based on cash basis and not based on accrual. So what that means is that anything that has to do with that is non-cash in nature, we need to adjust for it. So for example, I start for profit before tax, right? Now in that scenario, what the implication of that for me now is that I choose my profit before tax. I just press equal to, go to my income statement, right? And I choose my profit before tax. Now the implication is that I have I've not included my income tax expense. So I don't need to adjust for income tax because I'm starting from profit before tax, right? Now the next thing for me now is my interest expense. Now the standard allows us to prepare to put interest expense in either in our operating activity or the financing activity. But most businesses by default, based on the nature of business, default into putting interest expense in their financing activity. Because of that, we adjust for it, right? But if, for example, the business has chosen that it wants to reflect interest expense within the financing activity, then there's no need to adjust for it, right? Then secondly, you need to note that you need to ask yourself, the interest expense you are seeing in the P&L, is it cash or is it non-cash? Now, there's a probability that if the business is into, it has a loan, there's a probability that not all the interest expense is actually cash. So there are scenarios in which you need to ask yourself, the interest expense I have there, is it fully cash or non-cash? The good, for this particular scenario, our interest expense is fully cash. If it wasn't cash, you would see in our borrowings, if you notice, we have short-term borrowings. Based on our notes, if you follow through with our notes, we'll find out that we have short-term borrowings and we go there. Our short-term borrowings actually interest accrued. If we go to our FS mapping. So let me look for interest expense. I'm looking for its interest. Yeah, can you see? Interest accrued. That what makes our short-term borrowing. This already, if you see a balance here, then that means that, don't forget, the entries will pass to recognize an interest accrued is that we debit our interest expense, right? And we credit what? Our interest accrued. Right? This is a liability and this is an expense. Right? The implication of this is that if this happens, we will need to create what we know as a movement schedule, meaning that we'll ask ourselves, opening, what do we close with interest expense? For the sake of example, we close with 2 million, right? Interest expense charge. Now, how much of interest expense was charged to the P&L? By default, whatever we see in the P&L should agree with this figure. So for the sake of example, is 6 million, right? Then the next thing is that we'll now have what we call payment. Payment is what will reduce this. If, for example, we've paid everything, it means that we would have paid 6 million. So that at the whole, we have 0, right? In this particular scenario, no problem. And this is a similar scenario we have here. Our interest accrued here is 0, right? Meaning that everything we're seeing there is fully payment. Now, that scenario is that we could actually have had it that here is now 5 million, right? In which we have an interest accrued of 1 million. It means that we would adjust in the P and in our cash flow, right? We'll call this adjustment, right? And you see interest accrued or interest expense, right? Now, don't forget that in arriving at our profit before tax, we deducted interest expense. So now for us to adjust it, we now need to add it back. So we'll simply do equal to, right? Go to our income statement and pick the interest expense, right? And we add it back. Now, like I said, it's the payment parts we'll need. But in this particular scenario, we don't have our interest expense is fully interest paid. So we should not be worried. So meaning that whatever we have here, we'll come back to our financing activity and put that exact amount. But if it was the other way around, what would happen is that we'll come here, adjust the full amount in interest expense, and come here, what would now reflect is interest payment, which is a cash element, right? That's that part. Now, the next scenario now is that what other elements do we need to adjust? We need to adjust all the other non-cash. We have depreciation and amortization. So we can copy these two, come to a stream of cash flow, bring it here. There are deductions, so we need to add them back. So go to our IS and pick depreciation and amortization, right? For the sake of this class, to make it more presentable, we click here and bring it in so that it's clear that those things are clearly adjustments under this category, right? So with this, we can now go to the next step. The next step is that we will now bring in what we call our changes in working capital, right? Okay, sorry, before I go to change in working capital, in this particular scenario, we had an instance where we had other expense, right? Which was the disposal of assets, which it clearly stated that disposal of assets is actually an activity relating to investing activity. So a business acquired assets, right, and then decided to sell it. The sale of that asset is not the primary business of that company. So as a result, it's an activity within investing. So an asset you've acquired did not decide to sell them off. The implication is that it is not that portion is an investing activity related, is an investing activity related operation, right? So based on that, we need to adjust for it and take it to the relevant place. But don't forget that our loss on disposal is non-cash, right? It's just the loss. And don't forget our cash flow is based on cash. So what do? We also bring our other expense, right? It was a loss, so we need to add it back, come to our IS and add it back here. And we get this. Now the next element, like I explained, is our changes in working capital. Right? And you can easily format it based on this. Okay, just checking that we don't have anybody in the waiting room. Okay, so now that we have changes in working capital, now working capital we understand. Our changes in working capital has to do with basically 3 components. It has to do with the increase, right, or decrease in trade and other receivable, right? Same thing, increase or decrease in trade and other payable, increase or decrease or change in inventory, right? Those are your 3 components that make up your changes in working capital. Don't forget, depending on the nature of the business, right? This may differ from business to business. So for example, for a financial institution, what will make us achieve the working capital would be the loan and deposit. Loan is the loan that is given to me and you, right? And deposit is customer deposit. So deposit will come in two forms. It could either be deposit that, oh, I have a savings account, the deposit I make, or it come in terms of, oh, all this time deposit, whereby I put the money in the bank and try to earn interest over a period of time. Something like that. Those are what make up their own working capital. So now, based on that, what you need to be observant. One thing, key principle you need to understand is that an increase in assets, right, is an outflow. A decrease in assets is an inflow. There's a reverse for payable. An increase in liability, right, is an inflow, and a decrease in liability is an outflow, right? What does this mean? Now, for my liability to reduce, it means that I most likely paid money to the people I owe, right? So a reduction in it means that, obviously, that I have let cash go. Now, an increase, other way is, the implication of that is that I'm using someone else's money to trade. It means that I should have paid someone. So it means that my cash has increased to the tune of the increase in liability. For assets, for my asset to increase, it means that I'm tying down cash, right? Or I've used money to acquire an asset, right? So for example, I acquire inventory. Obviously, I'm tying down cash. I've paid money, money has gone out to increase, right? I sell goods to my customer. My customer owes me money. I have not gotten cash. So until he pays me, if he pays me, what will happen is that his trade receivable will drop. It means that there's an inflow. Now, if you understand that principle, basically what will happen now is that we'll go to our statement of financial position, yeah? And look at this portion. If you want to show that, we need to do opening less our closing. Can you see? Inventory has reduced, meaning an inflow. Can you see that it's positive? The same thing here. You do this less here. It has reduced an inflow, right? Now, for liability, instead of doing comparative less closing, we'll do the other way around. We'll do closing less opening, right? That's how we'll do it. So based on that principle, that's what we apply when applying our cash flow, right? We'll simply go to our cash flow, and when we're in trade and results, we'll put equal to, come to our statement of financial position, we'll do opening less our comparative less our closing, right? Inventory, the same thing. I'll do go to my statement of financial position, do, okay, sorry, let me copy this down. This was for inventory. Come here, right? I can do my opening less my closing, right? And I've done my trade receivable. I can do my trade payable, which I thought is the other way around. I come to trade payable, yeah? This less this, right? And we have that. So based on that, I can have my changes in working capital. So from this, I would have what we call cash generated from investing, sorry, cash generated, is that cash is generated or utilized from operating activity. Now, what does this mean? Now, if my cash, if the net impact here is positive, it means I've generated cash. But if the net cash there is negative, it means I've utilized cash, right? And trust me, when you see a negative value in your cash from operating activity, it's not a good sign. It means that the business is, as one way or the other, is either making losses, not in terms of loss in that way, but it's not making money from a cash point of view, right? And normally, as much as possible, this should actually be positive because that's the only way you can actually support other operations, right? It's a bad sign when you see the cash generated from operating activity as negative. One needs to understand why, right? Is it that they're holding more inventory than expected? Is it that their debtors owe them a lot of money? Is it that their trade payable, they are paying more cash out to their trade creditors, right? So you need to understand the dynamics, right? Based on that, this one thing you also need to take notice as the sign here. If my sign is positive, that's an increase, right? Or sorry, if my sign is positive, that's an inflow. Sorry, like that's not what I mean. If the sign is for assets is a reduction, we said it's an inflow, right? So it means that if there's an increase, it means an outflow. So I put it in brackets, right? So that someone can understand when he sees an outflow, right? So for inventory, same thing applies. I put a jacket to show there's an outflow. For trade payable is the other way around. Is when there's a decrease, that means there's an outflow. That's when I put in jackets, right? This will make it quite descriptive, right? Now I can add all the elements. One more thing, which I forgot to include. Tax paid. Yeah, I forgot to include tax paid. Now, good enough, from last class, we created a one for you for taxes. So all we just need to do is come here and say call to. Tax paid is an outflow, right? And let's go to our notes. And these are our payments. Press enter, and we have our inflow. Yeah. So now with this, we can easily just add this, and we get our inflow, right? This way, we've identified everything relating to operating activities that need to be captured. Now, in investing activity, typical things that come in investing activities: acquisition of assets, yeah. So acquisition of assets, we need just to pay attention. Typically, if we had created a fixed asset movement schedule, what we just typically do is link it to where our acquisition of assets is, right? But in this particular scenario, we don't have that. But don't forget that we had a trial balance for this scenario, and we had other information that provided to us, right? Based on that, we're told that additional data. We're told that the business actually spent 14.3 million in acquiring assets. Okay, let me see question. Okay, so someone said I should explain the interest expense. Okay, now I said that the interest expense, one thing I need to understand is that typically your interest expense can be your operating activity or your investing activity or your financing activity. Now, depending on what the business has decided to choose, but most businesses default to putting interest expense in your financing activity, default, right? Now, the second thing is that your interest expense should actually be the cash payment, not necessarily what you have in your P&L. So there are instances in which you have interest expense in your P&L, but not everything there is cash, right? And a typical way to know when everything is not cash is that in your trial balance, the GL that houses your interest accrued will most likely have a value there, right? And based on that, you can know what should be there, right? That's one way to identify it. However, what you could simply do, like what we did for our what's called it, our movement in taxes, we can create something similar for interest accrued, right? In the section related to loan, we would have a section, right? And we would have similar to this, open, close, right? We'll not have drawdown. We'll just say interest charge in the year. Yeah, we can have interest paid. Yeah, maybe most likely may not have this one. We may have it depending on the loan, may have that element. So based on that now, we already know our opening is our previous month closing, right? We already know our interest expense should be what you should have in, for the sake of argument, P&L. Let's see what we have, interest expense somewhere. Yeah, we have it here. Then if there was payment, we'll know the value there. But in particular scenario, interest at the end of the day is zero, right? So this should be zero. And we'll consider that our borrowings is zero and this is zero, right? Same thing should apply there, will also apply in this place, right? And we have that. And that solves our problem, right? Or if, for example, that was not the case, we have an opening balance, or maybe we may not have, we have interest accrued and we have our payment. By default, this figure we have here is what we adjust for at this level, right? Then in financing activity, what we have here is what we have as interest payment on this line, right? That's basically it. I don't know if I've answered your question. Yeah? Chizoba, have I answered your question? Okay, I didn't get any feedback from Chizoba, so I assume that I have answered his question. Oh, yes, you have. Okay, good. So based on that, right, we now move into acquisition of assets, right? Now, typically, if we have what we call a movement schedule is something of this nature, right? Where we clearly show a movement of what has happened in the assets, right? Shows all the activities, and this is what it looks like. Now, based on that, we would have a line for acquisition of assets, which is this line, right? We can have a total here now, which is 14.3. Now, this movement schedule is what we'll most likely pick and put in our costs here. It's an outflow, so we'll make it negative, right? We also have proceed from disposal, right? Proceed from disposal, right? Proceed from disposal. The implication for us now is to look at our disposal. Usually we'll have a list of assets that are disposed, the cost, the accumulated on the NBV. So clearly we can see that in this particular scenario, 65,833. Can you see 65,833? It was a loss, right? See the amount, the asset that we sold, and this is the amount that we sold the assets. So basically, we've adjusted for this. We need to adjust for this, right? The same price is 320, which is an inflow. So we bring into our cash flow, right? And put the figure there. Now, for other businesses, there could have been interest income, right? So if the business has done, maybe it has a fixed deposit, or they have some form of, maybe the bank has paid them interest on their cash balance, they could have that interest here, right? Don't forget, the same principle that applies to interest expense also applies to interest income. It's possible that you have not received the cash, right? Your interest income is maybe what has been earned. So for example, you have a fixed deposit with the bank, right? And most times the fixed deposit is only paid at maturity, right? Or when you liquidate the fixed deposit. Now, in such a situation, if every month you've been accruing, right, for the interest that you are earned on that fixed deposit, there's a high probability that when you have your income statement has both cash and non-cash elements. So similar to what we did for interest expense, you need to create a movement schedule to show what was interest has been earned in the period, how much is sitting as an asset in the books, and what has been paid by the bank, right? And based on that, you adjust for the one you're seeing in the P&L here, while the income actually paid would come here, right? Based on that, we can have our total here, and we can call this cash generated or utilized from investing activity. Yeah. Now, the next part is financing. Typical things that come within financing are, for example, issue of shares. Or let me just say issue of shares. Yeah, that's one. You could have loan repayment. Yeah, you could have interest repayment. Yeah, what else? Yeah, for the particular scenario, I think that's what we basically have. So for issue of shares, the good thing that we have a movement schedule. An issue of shares is an inflow because some would have paid you money for shares if issued to them. So you can easily go to our notes and go to the movement in share capital, and you have 1.2 million, right? Now, in this particular scenario, we said that because of the way it's structured, our interest payment is same as our interest expense in the period, so we don't have a problem with that, right? Our loan repayment, you need to go back to our additional information. We're given a loan schedule, right? And if you look at the loan schedule, we're interested in 2020, which is from this place all the way to this place, right? This is the loan schedule. And from there, we can identify all the loan payments, which is this, right? And based on that, we can easily do a sum total, sum, and pick all the loan figure. Loan repayment. Okay, sorry, it shouldn't start from here. Start from here. Yeah, we have 1.5. Now, don't forget that I don't think we prepared the borrowings movement in last class. So basically, the loan was taken first, was 6 million, and was taken in 2019. So we put our figure here, opening. Sorry, opening was 0. Then the drawdown was taking place in 2019. If you look at the dates, 1st of April 2019, 6 million. Put our 6 million, drawdown, right? Then the next part is, let me copy this. Okay, so 2019, this is the loan started from here all the way to this place. So we can sum all the payment that took place in 2019. Yeah, all, which is 1.125. You can put that figure here. There was no exchange difference in this particular scenario, so that's our total. Now, if you look at this, we have our borrowing as 4875, 4875. These two should tally, right? Or worst case, if for, okay, not for this class, but something else, there's a possibility that you would have reclassified some portion of the borrowings into short term, right? Because we typically, the standard requires us to pay that whatever is repaid can be within the next 1 year. It should actually be current element, right? We didn't do that in this current class. We're just making that known to you. That typically, you should actually do a classification of what is current. That means what is the loan element that's going to be paid in the next 1 year and put it within your short-term borrowings. So that way you can, when you sum this is your total year. If you add this and this, it should give you this. The only difference in the last scenario will be your interest accrued, right? So you can break it down to say your short-term borrowing is a combination of your interest accrued and the principal payment portion of the loan that's going to be due within the next 1 year, right? Like we rightly said, our opening is our previous month closing, right? We don't have any drawdown in 2020. We have a repayment of 1.5. So I put my repayment and I can put my total here. And you can clearly see that my total here equals my total here, which is fine. So I'm done with this element. So I can go back to my cash flow and go to my loan repayment, pick the figure from my notes in the current period, which is 1.5, and have my figure there, right? With this, I don't have any other element relating to financing activity. I brought in the interest expense, I brought in the loan repayment, and I've gotten my shares issued. Now, for other scenarios, you could see other elements that make up your financing activity, right? Also, the same in investing activity. For example, if I invested in a subsidiary, obviously the money I paid, the cash element of what I paid in investing in a subsidiary is stated clearly here. That's another element. If I put in my money in like a fixed deposit, obviously that kind of money will be reflected here if I don't put it within my cash balance, right? Now, another thing I need to bring to your attention is, okay, let me leave that for now, right? But it's a common mistake how people treat unrealized exchange difference in cash flow, right? Some other time we'll explain that in preparing cash flow, but it's a common mistake. Also, how people treat the unrealized exchange difference from cash. Now, by default, that should fall within your cash and cash equivalent movement. So basically, you have your opening cash and cash equivalent. Yeah, changes cash and cash equivalent. Yeah, then I have my closing cash. Yeah, so my opening cash is obviously what I closed with in my previous year. For the sake of this, I could not create any comparative for cash. I come down to my cash and I choose the figure here, right? I put my total here, which I've not done. Control B. I can come here, copy, and paste here, and change it to financing activity. Yeah, so that's my opening cash. Let me change the narrative here. Which will be the sum of all this, 1 plus this plus this, right? And I can now add this. I have 16.844. I go to my statement of financial position, choose my cash, and voila, put a check, and that shows me it's perfect. No issues, right? So any questions? So we're done with the cash flow. So I don't know if anybody has any question. I'm all ears. I'm listening to you. Wow. No question. Wow. No question. That's weird. Okay, question. Wasu, we are all ears. Can you ask your question? If you want to unmute your mic and ask the question. Trust me, we are here to answer your questions.
Hello.
Yeah, hello.
Yes. My question is on the asset acquisition.
Okay.
Yeah, I was thinking that if you dot the closing and the opening, you have it in the FS, as in the balance sheet, that you will get that figure. But you went to another to get it. So
okay, so let me tell you how the movement in. So typically, the best place to get acquisition of assets is actually your movement schedule, because a lot of things could have happened in an asset. An asset could be acquired, an asset could be disposed, an asset could have revaluation, an asset could have impairment. There are so many things. So typically in this last one, right, in the trial balance here, we had created additional information to help you prepare a movement schedule, which is this, right? Now, this movement schedule, if you look at it, shows you all the activities that are taking place in the year, right? In that, so it has your opening, it has the additions, it has your transfer between classes, and it has your disposal. Typically, acquisition is this line, and that's why we used it.
Yes.
So if you try to do net movement, for example, you wouldn't have considered disposal. Yeah, you wouldn't have considered disposal. Also, you wouldn't have considered the fact that you wouldn't have considered depreciation. So, for example, now, if I want the approach you are adopting, usually when there are no disposal, a simple approach to do is say, go to my statement of financial position, right? Say this is my. If I do what I closed with or what I opened with plus my depreciation for the period, which is this, right? Automatically, if I do this less this, it should give me the amount that was invested in the period.
Okay.
Or let me do it this way. Sorry, let me do it. Yeah, okay, sorry. Add it. Sorry, this is what I should have done. Add the depreciation, subtract depreciation from this. So by the time I remove depreciation from what I closed with from last year, it should actually give me, if I did not acquire anything, it should give me exactly what I have here. Right? If I take out depreciation from this line, it gives me exactly, it should give me exactly what I have here. It's because of I have acquired asset and a disposed asset. That's why when I when I take out depreciation from this asset, which is 8 million, it doesn't give me what's here. That change will now be explained in the movement schedule, right? Which you showed, right? In the movement schedule. To show other elements, it could have been acquisition of assets, it could have been disposal. So for example, if you look at it carefully, if I compare my addition and disposal, if you look at it, it's 13,690. And if I come here, this gives me 13,914. Obviously, yeah, because of there's disposal that has to do with accumulated depreciation. So let me copy this and come all the way to this bottom, right? So if I add all these three together, 14.3 plus 610 plus 224, right? You see 13,914. Can you see that explains 13,914? So you cannot just use the fact that, oh, the movement in it and arrive at the figure. So already your movement schedule, right, in PPE actually explains that. I think there was a point in time the video was created. Let me check. On the YouTube channel covering movement schedule, right? we didn't plan to cover that here, but let me find the link for the movement schedule video. Yeah, I think this year we talked about it.
Okay.
So I can drop that so that if you have time, you can take your time. Yeah, so that's it. So I don't know. Does that answer your question?
Yes. I would like to go with with your style. It's better and it's very straightforward.
All right.
Thank you very much.
Okay, thank you, Mr. Olad. Good afternoon, everyone. Good afternoon, Mr.
Yeah,
Oladele.
good afternoon. Yeah, good afternoon.
Yes, so Wasiu is my name.
Oh, hi, Wasi.
Yes, fine. Thank you very much. Thank you for this very expensive and elaborated lecture. Very elaborated, very educative. I really enjoyed it. May God continue strengthening your brain. And my question is, we have some software, especially the software we are using. We have debit, like trial balance, TIBA. We have debit and credit separately.
Okay.
Like this example, the one we are working with, it look like SAP, in which the credit side is used as a negative. But in some software, how can we do it in which we, in a situation whereby we have a debit?
Okay, so I'll quickly do something.
It and credit separate.
Okay.
So the man can go about it. Or like this one that we have a one column for both debit and credit.
So I want to create a scenario. I want to create a scenario. I want to create a scenario. What you just explained. Yeah. I want to just create what you just explained now for you. So I'm creating it now. So this is my debit, this is my credit, right? So let's assume you've exported your trial balance and it comes in this format, right? Debit and credit.
Yes.
We already know that credit should be negative and debit should be positive, right? Right?
Yes.
So make it in this format. All I need to just do is just do debit minus credit. And I have that and I drag it down. That we have combined it. And that's all.
Okay.
Right? I just debit is positive, credit is negative. All I need to do is debit minus credit, and I get my figure here. And that becomes in the format I can use, which matches what you have here. Yeah? Does that answer your question?
Yes, it does. It does.
All right.
It does.
Okay.
And secondly, sorry for bringing the class a bit down. In the classification of SO statement of TIBA rather. Out of this, the list of GLs we have, how did you just summarize it into? I think you did remove duplicate. Is that what you did?
Okay, so now
what just summarize it into.
So now what I tried to do
summarize all the names to the key names. So you summarize those use remove duplicate in order to summarize it to sub-headings. Or how did you do that?
Okay, so this is what happens, right? So the first starting point I ask myself is that I even look at it from the first face of my statement of financial position and my income statement. What are the things that should be on the face? Identify them, list them down, right? So for example, we listed all the things: revenue, cost of sales, operating expense, other expense, depreciation, amortization, interest expense, income tax. I do the same thing for statement of financial position, list all the components. Now, there are certain components that require you to break them further. So I give an example of operating expense. Your operating expense could have many components. It could have communication, it could have travel expense, it could have rent, it could have professional service, it could have staff costs, it could have different things. So I identify all that, right? So I identify all the possible classifications I want. Now, at the trial balance, I do the first level of classification. The first level of classification is exactly how on the face I will see it in my income statement, and on the face how I will see it in my what's called it, in my statement of financial position. So this is my FS mapping. This first column is exactly how I'll see it on the face of my primary statement. Now, The next level is now, how do I want to see it at note level? Now, I want to see the note level is how I'll classify it on the second level here. So the thing is that I did remove duplicates because I already had that classification already. But if I did not have it, what would happen is by default, I will start one by one and list all the possible classification I would need based on one, my understanding of the business, right? Two, what are those things that management is interested in seeing in the face of the financial statement and at the note level? So those are the two things I will consider, right? So it's not just duplicates, it's me understanding what the business needs to see and what management wants to see. And what typically a typical statement of financial position or income statement should have. Yeah? So that's that one. Does that make sense?
Thank you very much. Oh, thank you very much. Thank you.
You're welcome.
Yes, it is. It is.
All right.
It is. It is.
Any other question?
Good afternoon, sir.
Yeah, good afternoon.
Yeah, my name is Hamad.
Okay, hi, Hamad.
Yeah, I'm fine. Yeah, thank you for the wonderful lecture you have given to us. I have a question to ask on this interest.
Okay.
Hello, sir.
I'm with you.
On this, what of if it is interest on loan from intercompanies transaction, intercompany accounts? Okay. So are we also going to consider them?
So now for
this
cash
flow statement.
Now you should consider them, right? Because whether I like it or not, it will form part of your financing or investing activity as the case may be. Now the question you need to ask yourself is that normally at the trial balance level, I would expect that the intercompany has given you a loan. You should separate it from what you have as normal, maybe reimbursable expenses that you have with intercompany. So you have a dedicated GL that houses your loan with intercompany. I also expect that you separate the principal element of that loan from the interest element from that loan, right? It helps for clarity, right? So you have a GL that handles the principal element, and you have a separate GL that handles the interest element. Now, the question I'm asking is that the interest element that you have, has it been paid for? So like we did for the other one, you also need to have a movement schedule, right? If all have been paid for, then it should flow into your financing or operating activity based on what the business has decided to choose, and should ensure that it's consistent over time how it treats, right? Now, if they are paid, let it form your financing and let it show there. But if they have not paid, when you adjust for it in your movement in operating activities as a non-cash item, you will now leave it blank in your financing activity if none has been paid. Because typically most times when you have intercompany, some people don't even pay. To take a while before they finally pay.
In this case, we don't always pay, so we just book it. So that is why I'm asking the question: that how are we going to treat it when we are not paying, when the interest are not being paid?
Then to not flow into, you not see it in your financing activity. You adjust for it in your operating activity because we've chosen to use interest expense in our financing activity, and you will see it.
Okay.
Right. And the major thing that you need to note is that in our notes, right, in our borrowings, we can create a category called, right, borrowings from intercompany, right? Just to make it clear. Because one, if for example, you want to do a consolidation, it makes it clear for you to do consolidation, right? And also helps in managing it in terms of how you treat it in your movement.
Okay.
Okay. All right, thank you.
Then another thing, we are talking of interest income under investing activities.
Yes.
Should that also consider all this interest on a domiciliary account, interest income on this domiciliary account? Should we also consider that one on?
Yeah, sure you can. Sure you can.
Okay, but what of the interest aspects? What of bank charges? Should that go to admin or go to interest again?
No, so typically, right? So the thing is that what do you classify as bank charges? So people just call it bank charges. So for example, I transfer money to a third party, right? The bank charges me for that transaction, right? Or account maintenance, that's bank charges. That should be operating activity, shouldn't be financing activity.
Okay.
Do you get? That should be operating. That's like an admin expense.
Yes.
So is a typical pitfall the treatment of bank charges. Okay. Is there any other question?
Okay, thank you, sir.
You're welcome.
No, for me. Thank you, sir.
Okay.
Yeah.
Any other question? In the absence of none, right, that brings us to the end. But before we end, I don't mind seeing the faces of people that we've spoken to in the last 3 classes. I'm going to stop sharing my screen. Let me turn on my camera so that you can see me. You can see me where I am here. If you want, so that if I see you on the road, I don't say, I don't know who I'm talking to. So you can turn on your camera if you wish to. Something you're not comfortable with, then no problem. So I guess that's all for now. I don't think any other person has any other question, to the best of my knowledge. Okay. So
thank you so much. God bless you, sir.
You're welcome. Okay, so one quick question now, which I want to ask is that beginning of the class, I mentioned something. I said that, we may not be able to have this every time, but we can plan to have it maybe once in a month. And we need to identify what other areas that we think we can do going forward that we could actually just have a session on to discuss it, right? So I was asking, what other thing do you think we can do again to help improve your knowledge in your place of work? Obviously, it has to be something that will apply to everybody, right? And not just one person, so that as much as possible, we get a lot of people involved, right? Like I mentioned in the last class, I mentioned the fact that I heard something which makes me feel very bad, that people are doubting the competence of accountants, which shouldn't be the case. So one way or another, we're finding ways to help improve the quality of accountants out there. So, Oloyede Motunaya, I don't think I heard your voice throughout the training. It would be nice to hear your voice now. I can't hear you. I don't know if you're on mute or your speaker is not working.
Afternoon. Can you hear me now?
Yeah, I can hear you.
Okay. You heard my voice yesterday.
Oh,
I was one that told you that people was hectic.
Oh, okay, all right. No problem.
Yeah.
Sam
So thank you for the lecture.
Yeah, welcome. Bye. Miriam.
Shit. Then.
Okay, maybe you could type, because since the network in your area is not really good, you can just easily send a message, and that would help. Just send a message on the chat, because it seems your network is not really good. Ismail Odunsayo, Hilary, Jide. I'm going to type in accounting yards email, so that in case you have suggestion on what we can do another time, you can just send email of what an area. Someone mentioned budgeting, so I've considered that, right? Large extent to me, budgeting involves modeling. So a budgeting class will take a while. Not like when I say it'll take a while, it doesn't mean that we'll not do it. It means that for us to do a budgeting class, we'll most likely spend like 3 or 4 classes on Excel itself, right? Then we'll now put a class on budgeting itself, right? Hopefully we can plan that, because already we're in year end and a lot of businesses are doing budgets. So Sami Kolawoli said, thanks for the lecture. We are really enjoying it. You're welcome. Miriam said, thank you for your time. You're welcome. So I think that's all. Oh, so we have 2 Wasiu. We have Wasiu and we have Olatunde Wasiu. Okay, I don't know which of the Wasiu we've been talking to all this while. But it's the same person connected on 2 different platforms.
Yes, it's me. I'm connecting through my speaker is not good, so I'm connecting through my phone.
Yeah, he said so. All right. In the absence of no further question, and that brings us to the end of this three sessions of management account. All right, do enjoy the rest of your week and all the best in your various endeavors. Take care.